everybody. Welcome to the podcast. Happy New Year to you. It's our first podcast of the year. If you're just joining us for the first time, this is what we do. We look at the screens. We look at the markets from a technical perspective. We're going to talk about the markets, what's going on. We got about 45 minutes before the market closes here. It's about 2:20 as I'm recording this Central Time. And it's been quite an ugly day. We've had the Fed minutes. Of course, we've had North Korea launching their nuclear, doing some nuclear testing, and just not good, right? Not good across the board. And probably more concerning than anything, I think, for the markets, more so than these geopolitical risks which are out there, Saudi Arabia, Iran, all of that. I think more so what's causing the market struggles is the fact that the Fed has hiked, and obviously they say they want to do it 4 more times in 2016. I think that's highly unlikely. And so what's going to happen is they're going to take the data as it comes, right? Well, the problem is they've hiked, and they should have been hiking. Many people feel like the window's closed. They should have already been doing it. And now what you have is the economy starting to slow down. We've seen it happening internationally, and now is it spilling into our country? And we're getting some manufacturing data that's weaker. Services is still okay. You saw it. The auto sales still very strong. Missed the estimate yesterday. I still think they're strong, and I think they're going to continue to be strong. But having said that, let's take a look at the markets from a technical perspective. You can see the Dow Jones here. We were kind of in this pattern of starting to kind of, we were going up, and then it started to roll over, and then it just cascaded down. Once you kind of got rid of this, and we got back to where we seem to be starting back again, falling back down this little channel here. So we're getting to the point now where you should expect a bounce. Will we get more of a selling the rally than buying the dip? And you're starting to see some analysts come out and start to say that hey, the buy the dip is over. It's more about selling the rally. And I think we should look at that as well, because the market's been innocent until proven guilty in the last several months. This was such a quick sell-off, and we got this bounce, but we did see we didn't see the confirmation with that. Having said that, again, interest rates are still low. Doesn't look like the Fed's, we're in this Goldilocks economy, and to where the stock market would like that. And it does seem now we're starting to get a little more selling bias as the New Year's come into play here, and we're certainly breaking down a little bit below some of these moving averages. So that's the S&P, or excuse me, the Dow. We'll look at the S&P here. Same kind of picture. I do want to caution you, if you look at charts on certain programs, they look a little different. And some of the ones I look at, they include dividends, and some do not. This does not include dividends, so it's just the price action. As if you had a big dividend that was posted yesterday, it would adjust yesterday's price down to reflect that. This doesn't do that, and so it makes the charts look a little different. But the bottom line is, the way I kind of see this is, here we are in the S&P, and I think we're potentially getting to some support here. Once we broke through 1990, we bounced here, we came back down, and we bounced again and couldn't get back through. Finally broke through it here, and then it became support. And it became support, in late December, and here we are again, very close. Now, it could break on through, but we're in this kind of area here of 1980 to 1990 on the S&P 500. But what I would suspect is maybe a bad, depending on what happens the rest of the day today, but I would suspect we would have a bad opening tomorrow, a little further down, because we're still not at that fear zone. And we measure how much panic and fear there is, and I don't see a lot of it right now, which is a little concerning, because that's when you get bottoms like we had in August. So I would suspect a down, a little more down. Then you get this turnaround, you get this rally. But again, until it breaks above there, we're just in a what looks to be starting some type of downtrend. So again, you don't want to try to sell on days like today, but if you get some type of bounce, then up here is where you do it. And then you might even consider adding shorts, which we would do at that time as well. We would consider adding shorts at that time. So, but that's one of the things. Obviously, there's a lot of stuff concerning market, but I think it's still growth more than anything, and the fact that the Fed seems to be in a tightening cycle. But I don't think they're going to keep tightening. They're going to, obviously, they wanted to do that one and done, and they did it, and that may be it for this go-around. So, and then, the other thing that's happening today is obviously oil down over 5%. It's just getting uglier and uglier. We had this little bit of a rally late in the year. If you look at XLE, some of the energy stocks, again, I would still say I'm putting my, I think line in the sand still is a good investment at these levels, an investment. But you can't, trading, it's going to be too hard. It really is. And so from that standpoint, you just buy it and you just park it in the portfolio. And whether you want to own individual good companies or a basket, either way. But to trade, it's very difficult. But obviously, it's you're not getting it going up even on some geopolitical risks, which is a concern in the short term. So let's see if this kind of, it's been holding this level here, breaking down. Do we start to get some reversal at some point? And I think you'll get rallies, but what you need to get is more of a turning around. We've had this down. We've kind of moved sideways if you could kind of look at some of these moving averages, and now we're starting to head back down again. So keep watching oil. That's a big driver right now. On the positive side, take a look at gold. I think gold still works here. I don't think you're too late buying gold. I think that we actually, fortunately, we sold, we got a decent amount of cash, probably anywhere from 13 to 17% cash in most of our stock models. And we did lighten up on Monday. And then secondly, we used some of the money in one of our strategies to buy gold. And that's working today, obviously, with the North Korea news. That's working. But you're seeing it break out a little bit here of the sideways pattern. So we could get more of a run on gold, potentially, a lot higher, maybe even up in the 110 range on GLD. So look at that. We've owned GDX for a while in our aggressive strategy, which has basically been moving sideways. It's been volatile, but moving sideways. Does that start to break out? And they're up a couple percent today, not as much as you would think. But with the stock market down, it's tough. Remember, these are stocks. So gold's actually doing almost as well as the miners, which is very, very rare. If you take a look at the volatility index, we're getting up there. We're above 20 now, but we're not seeing the type of spiky, situation like we did back in August. So, or even December. But, another couple of days of this, and you'd start to see a little more panic. But GLD's working. I did want to also get to a couple of stocks people were asking me about. I'd looked at Tesla earlier. This was starting to look interesting a couple of weeks ago as it was kind of working its way higher. And basically just broke down. And sometimes you see that if a stock falls and then rallies a little bit and then this wedge happens, it sometimes breaks up to the bottom, and that's what we're seeing. Interesting company, but just very volatile stock. If you take a look at Alibaba, that was another one that's been interesting. We were watching this very closely at the end of the year. We're real close to putting on a short-term trade with this because it was bumping up against here, and it was very unusual that it literally was stuck at this $85 level. It made me think that something else was going on technically with this, with the computers trading it or something. But that eventually broke that uptrend as well and has been down since then. Ford is another one people are asking me about. Ford's interesting. Of course, Ford's going to be coming out with earnings soon. And this is, to me, one of my favorite stocks out there. I think not only is it cheap, not only does it pay good dividend, not only are they hitting on all cylinders, but I think what could be hurting it is just the big picture of, international. That's where their sales come from. You got the dollar. You've got just a very cyclical type company. And Ford is a little more expensive than it's been historically. So relative to itself, it's not dirt cheap. But if there's going to be a few companies I park and leave, this is one of them. And you can see here, I think it's actually at this $13 range. And if we go back a little further here, you can see 13's been an interesting spot in the past. So again, is it a trade? I think there's other things to possibly trade, but I do like it at $13 for sure. When we own it in our dividend strategy, and we also own it in our aggressive strategy, and it's been hard to watch. But you have to remember, this came off of this was a very beaten up stock coming out of the financial crisis. Remember, it got down to $1. So the fact that it's run up to, got almost up to 20, it's kind of been moving sideways. In fact, even in the last couple of years, it had run from $8.50 to $18 or so, and now it's just pausing. So, again, it's been a baffling one, but we still like it a lot and wouldn't sell it here. And if we're buying it, we'd be buying it under $13 all day long. Another one to look at is Apple. Apple's been interesting as well. Some people pointing out that we have what might be considered this kind of head and shoulders pattern. I don't know if that if that makes any sense. It's got three heads here, if it is. But just looking at Apple here, I think again, if you go back, look at this. Go back a little further here. I think it's got some interesting support right around, right around kind of where it is right now, but certainly the $95 range. So between $100 and $95, I think you'll find some support for Apple. I mean, after all, it still is off 25% from its high, which was in last summer. And it should be. We talked about the Apple Watch being too expensive long ago, and I just don't think it's done what they thought it would do. They're still selling a lot of them, but not near as much as people would anticipate. So the price needs to come down. They need to innovate some more, and they will. And the problem is still they have a bunch of money overseas. They can't bring it back in because of the tax system, and so they have to issue more debt. If they, and that's a silly thing they have to do. But once it broke this wedge pattern, that was kind of it. And then we had the August sell-off. It bounced back a little bit, but you can see these moving averages starting to roll over, and it never quite got back up. So, but again, people pay way too much attention to the stock. This is one you're still fine owning somewhere in the sub 100. I still love it, and we own it in our dividend strategy, which I've talked about in the past. What else here? Facebook is another one that we own. It's up a little bit on the day, actually. We've owned it for almost a year now, and we've trimmed a little bit of it back in here, somewhere in here. We trimmed a little bit of it because it had grown too much as a percentage of the portfolio. So that is one, though, that, again, sitting around $100 or so. It's got nice support around $100, but that's one people are watching. If you look at Netflix, having a monster day, up 8.5%. It's completely reversing that nasty day on Monday. And so they're going into several more countries, and it's a choppy stock, though. It's from a technical standpoint, it's kind of difficult to determine if you want to trade it or not, and it's an expensive stock, but it is one of the FANG stocks. And then if we look at Amazon's another one that was kind of toppy here. Couldn't really try to break through. What was that? A couple days before Christmas here, after Christmas, and has broken down. But this uptrend's still intact here, so I would look for this maybe around $600 would be a buy. Again, if you're wanting to buy Amazon, I think Amazon's very interesting why it goes up. It's a really interesting case study on stocks that go up and that haven't had earnings, a lot of earnings, but they are kicking butt and using that cash in different ways. And so that's been an interesting one. And then Google is one that I'd like to add. I haven't, and regret not adding it, but I do think it's still interesting just because it's one that is just one of the tech companies to own. You can see it's kind of at some mini support there. If it breaks down, I would look for it to go down to around $700, which I would be all over it at that point, $700. So as we speak right now, the Dow's trying to make a little bit of a comeback, down 265 as opposed to down 330 or whatever it was just a few minutes ago. But it's really kind of indiscriminate selling. It's across the board. You're seeing it in commodities. You're seeing it in the stocks. You're seeing it in the Russell. Doesn't matter the size. I think what's interesting to watch is what's happening with TLT treasuries, because they're still down from a year ago, and you would think, well, if the economy is so bad and people are so panicked, why aren't they buying? Shouldn't they be buying treasuries? And they're not. But watch this for a breakout. This could be an interesting chart if it starts to break out here. If there is more risk off, which we're just not seeing a ton of risk off right now. The other thing is there's stocks holding up. You look at utilities. They're actually flat on the day. REITs are actually down a little bit, and they're holding up probably a lot, half as much as the market. So they've kind of been moving sideways. So you're not seeing this all-out selling across the board, but you are seeing it in stocks, for the most part. But there are things that are green today. I mean, there are a lot of stocks that are green. Some cybersecurity stocks. We have CES going on, which is the big consumer electronics show in Vegas. So a lot of stuff comes out from there. And every time that happens, you're seeing some stocks that are popping on that. whether it's Netflix or something else. But in the big picture, this is the trend that I'm kind of seeing right now. And again, I think look for soon some type of relief rally. And until this downtrend's broken, we're going to continue to do this and keep falling. So if we get weak rallies from here, don't be afraid to raise some cash, and also don't be afraid to maybe take the other side and actually go short. It's been a difficult market to short, and obviously been a difficult market to be long. But I do want to emphasize still, there are still places to get income and outside of the stock market, and that's what we're trying to do with a lot of our clients, is not just look at the stock market, because trading has been very difficult lately, and obviously buying and holding has been difficult lately. So it's just been one of those challenging times. You can't force it, but I do think there are things to do, and then there are companies that are good quality companies that are and should be bought for investment, and a lot of those are in the energy space. So that's an area to look at, as opposed to looking at these high flyers that have been holding up. Remember, a lot of the gains last year came from the FANG stocks, and those have had trouble the first few days of the year, and that's why you've been seeing the indices go down now with the rest of the market. A lot of stocks had already been going down. Now the indices are kind of following suit. So that's where we are right now. Don't forget, every Saturday morning, 9 a.m. Central Time, we do our radio show, the Eggers Report radio show. And for those in the San Antonio area, I'll be doing a sit-down interview on the local CBS affiliate tomorrow at 6:45, doing some kind of New Year financial planning tips for the New Year, some reminders. So if you can tune into that, I'll see if they post it on the web, and perhaps we can blast it out. But if you're in the San Antonio, South Texas area, it'll be on the CBS affiliate at approximately 6:45-ish. All right, take care, everybody.